Welcome to the Insightful Investor Podcast, a weekly series that seeks to share industry, investment, and market insights. Learn more about our show at insightfulinvestor.org. Today's guest is Jason Thomas. Jason is head of global research and investment strategy at Carlyle, which manages about $465 billion as of the end of June. Before Carlyle, he served on the White House staff as special assistant to the president at the National Economic Council. Jason, welcome to the show.
Thank you so much for having me.
Let's kick it off with your background. What would you say originally inspired your passion for global economies and markets?
It's tough to say because it's always been my main interest. I remember in high school, I was so excited to take AP macro and micro and getting through the other social studies to get into those classes. When I was looking at colleges, I was very focused on the economics departments. So, it's a strange thing. I know a lot of people enter college not really sure what major they'll ultimately pursue. They go out into the real world, quote unquote, not sure what sorts of jobs they want to get involved in. I guess I was fortunate in the sense that this has always been the direction that I wanted to go.
Are there any elements about it that you think have drawn you into this industry?
I always have an interest in incentives, inefficiencies, in opportunity cost, just this a sense of trade-offs. Those are always concepts, I think, that I experience in the real world every day that always sort of resonated with me. And so applying those concepts in somewhat more complex circumstances, it's always that's been a subject of fascination for me.
It sounds like just a general interest in how things work, especially when you get into the complexities of not just how machines work, but how people work together.
No, I would say engineering is something that if I had a second area of interest, it would be engineering. And I do even things around the house when they break, as long as it's not electrical, I'm not putting myself at risk. I will, try to fiddle and figure it out myself. So I think that, there's an engineering interest as well, I would say.
Would you tell us about your experience at the White House and any key lessons or perspectives you gained from working at the National Economic Council?
Yeah, so I was the head of public finance. And so it was liaison with the Federal Reserve, with the Treasury, focused on budget, macro, balance of payments, contingent liabilities, those sorts of things. But I was there at a time when the financial crisis ultimately hit. What of course we did not recognize was going to be as large a problem as it ultimately proved to be. So, 2006, 2007, 2006, of course, the start of the housing downturn. 2007, I remember August very well, where the money markets froze up, and it was questions about illiquidity and what this portended about the broader financial system. So really the last few years, virtually all of my time was spent on housing issues and, of course, thinking about the broader issues of financial stability in the financial system. And this was really an incredible learning experience. I really came to understand how broker-dealers, investment banks fund themselves, how different types of assets find their ways into different markets. There was, of course, the complexity of all the various acronym vehicles, and very often ultimately finding its way to the money markets. And also just the extraordinary dependence on the money markets, the fragility of the finance. Many of the large broker-dealers, by the end of that period, as they'd have shortened their liabilities, we were in a situation where they had to roll over $400 billion of liabilities every week through repos, through commercial paper. And of course, we also discovered about how many of those vehicles, SIVs, asset-backed commercial paper, conduits, et cetera, were ultimately puttable to the balance sheets of these institutions. So it was, again, a fascinating learning experience. And I think more than anything, learning about the stability and durability of certain liability structures, how certain types of balance sheets can handle risks that others simply cannot. And I think, in defense of those companies, for the most part, because they're functioning as broker dealers, they viewed these securities as inventory. Well, just as a retailer, you finance inventory, which you expect to hold on a short-term basis with generally short-term liabilities. It just so happened, of course, that they could no longer sell or move these liabilities. And then suddenly those short-term liabilities became what ultimately put the entirety of the financial system at risk.
So I guess you got to see a little bit of the plumbing from the inside.
It was a plumbing tutorial that lasted for a couple of years. And so, yes, it was extraordinary learning experience for me.
And what motivated your transition from public policy to Carlyle? And how do you think that shift shaped your approach to research and strategy in a large investment platform?
I find that I do very similar things, and it's a different clientele or different client base, you could say. So when I came to Carlyle about 15 years ago, I was the first director of research. And really, what I was doing was providing macroeconomic advice and analysis for the CIO, Bill Conway, and the investment teams. And also, what was interesting was I got to put some of my training in financial econometrics to work, because much of what he wanted and David Rubenstein and others asked me to do was to try to analyze portfolio company data. Obviously, we have a very large portfolio of companies, it runs in the several hundreds. Today, over 150 control positions or large enough stakes where we can get enormous amounts of data, not just financials, but key for performance indicators, looking at the order books, looking at prices paid, prices received, lots of other metrics that are of great value. And really the idea was to try to distill what is macroeconomic in origin. So what could we learn from these data about what's happening in the economy? And also what is idiosyncratic? What is this company doing that's perhaps differs from what you'd expect based on its exposures to macro, its risk exposures, its growth drivers, et cetera.
I know you spent a lot of time thinking about and discussing the market outlook and the economic outlook. So I'd like to ask you some questions in that regard. And let's start with inflation, one of the big topics today. After more than 4 years of above target inflation and inflation volatility at levels last seen in maybe the 1980s, do you feel like we're in a new inflation regime?
I do. I think that that's almost an unmistakable conclusion to draw from this experience. It's back to school season. And I think it's interesting to note that there are about 3 million children who are getting their first taste of formal school in their pre-K 4 education. And not a single month in any of these children's lives has the Fed hit its 2% annual inflation target. That's pretty remarkable when you think about it. And so even when people talk about inflation not being a problem or inflation's come down meaningfully, yes, it did, but again, still not to the level that the Fed, through a formal statement in 2012, the level that they formally committed that they will hit. And I think that, of course, we've seen recent data that's suggesting that inflation's a bit higher than people expected, but let's just go through those statistics. So first, you had core CPI inflation that came in through July at a 3.1% annual rate. Well, that's actually right on top of the 18-month average. So for the last 18 months, core CPI inflation has been 3.2%. If you look at the core PCE, which the Fed, of course, targets its preferred measure, that was 2.8% through June, also on top of its 18-month moving average. And then you could say the same thing about the 3.3% annual increase in core PPI inflation. So it's interesting if you look at the news and the market reaction to some of the recent inflation prints, it's been surprised that they've been a bit higher than expected. But in fact, they're exactly on top of where these numbers have come in for the past, again, 18 months, since the end of 2023. So this has proven to be a much more intractable problem than people supposed. I think that this presumption that everything would sort of return to 2019 once we got that initial spike of inflation, which again, people attributed to a supply chain crisis. Once that was over, everything would revert back to as it was prior to the pandemic. That just hasn't proven true.
So I'm curious. We know we have these massive deficits and high government debt. Should the government accept higher inflation as a trade-off for managing its growing debt?
Well, this is an issue that I think we're going to confront, and it's the issue of fiscal dominance. The reason that you have an independent central bank is because the Treasury or the finance ministry in other countries, in advanced economies, is able to borrow, issue debt in a currency that another arm of the government, the central bank, can print. So, this, from an investor perspective, this seems like kind of a dangerous situation. This would be like Microsoft issuing bonds instead of being payable in US dollars. Those bonds, both the coupon and principal payment, would be payable in Microsoft stock. Well, you never worry about a default event. The corporate treasurer can always issue more shares. What you'd worry about is what those shares are worth. And that's the situation that, again, advanced economies find themselves in, and why central bank credibility is so important. Because there's always this tension, or at least this risk, that these obligations are just going to be inflated away, that the one arm of the government, the central bank, is just going to print in whatever quantities are necessary to ensure that the other arm of the government, the Treasury Department, can fund itself. So I think that the idea of accepting higher inflation, it sounds very appealing. We just saw in 2021, when you think about how low yields were, well, there was very large capital losses as a result of that. When inflation went up, when interest rates went up, when bond yields rose, the market value of those bonds fell by some to 15 to 30%, depending on their duration. So investors, essentially, their wealth, you could say, was expropriated. It was effectively transferred to the government. And it's interesting because it feels as though bond market investors feel like that was a one-time event. So yeah, I bought this 10-year treasury bond yielding 1.5% for 100. Now it's worth 73 or 76. And well, that's too bad, but I know that'll never happen again. And I wonder why everyone is, or at least again, based on market yields today, why everyone's so confident this was in fact a one-time event.
How sustainable do you think these fiscal deficits are? And is your sense that the market is finally starting to push back on continued government borrowing? In other words, are we getting closer to crossing that line?
I think that very often the discourse about debt and deficits has almost a binary feel, where it's on the one hand, everything's fine, or on the other hand, there's going to be some massive crisis, and people just refuse to buy treasury bonds. I don't think that's the right way to think about this challenge. I think that, first of all, when you look at what does a deficit mean, it simply means that you have a treasury general account that is crediting private sector bank account balances in excess of how much it's debiting those same bank account balances. So it's pumping excess liquidity into the system. That liquidity, of course, is then withdrawn through the bond issuance. But right now, you have a funding mix that is overwhelmingly, or at least has moved in the direction of shorter term finance, treasury bills rather than bonds or notes. And so that has been sustainable because you have very large money market mutual fund balances, lots of demand for treasury bills. There's also, of course, stable coins, and that could also increase. They're generally collateralized by T-bills. This may be a new source of demand. But the reason I bring this up is because I think that you first should see the effects of deficits that are too large in inflation. That, again, it's just more money entering the economy, more liquidity entering the economy relative to what is being withdrawn through taxes and other receipts. And then secondarily, you would start to see the effects of all of a sudden bond market investors, treasury investors, starting to worry about the real value of their principal payments. That in 10 years from now, when my principal comes due, what is it going to be worth in real terms? Is there some prospect that there are some episodes of 5-6% inflation that actually really erodes the purchasing power of the money I'm going to be receiving back at that time? And then you start to get into, of course, higher yields, and then that exacerbates the fiscal deficit because now you have an interest expense that is consuming a larger share of the economy. So it can be, it's one of those, I think, problems that can be more slow moving than we think, that it doesn't actually, the crisis, if one arrives, is going to be preceded by a lot of, more regular sort of dysfunction or signs of impending problems. And I think that in some ways, we're starting to see that. I don't as yet see much evidence that bond market investors are have responded or are particularly concerned, given that yields are still relatively low. I mean, right now, of course, you can have maybe a 4.1% return on your money market mutual fund balance, only pick up maybe 15 or 20 basis points if you lend to the government for 10 years. Well, if people were genuinely concerned, I think that gap would be far larger than it is today.
Yeah, I suppose the metrics you can watch to see if we're getting closer to that critical inflection point is yields. You can look at inflation, and you can also look at the currency, right?
That's important. The dollar entered this year, as of January, at its highest level in its foreign exchange value on a real effective basis since 1985. And of course, in 1985, the dollar was so overvalued that it led to the Plaza Accords, where G7 central banks, finance ministries agreed to intervene in the market to reduce the foreign exchange value of the dollar. So again, it's important. Initial conditions here are very significant. The dollar was very richly valued as of January 2025. But of course, since that peak, the dollar has sold off pretty significantly. And it's interesting because when you look at the stock market performance, very strong. It's not quite as strong if you think of it in euro terms or Swiss dollar terms. And that may explain part of it. But yeah, I think that whether there's depreciation against other currencies, which means a decline in the foreign exchange value of the dollar, or it's a depreciation against goods and services, of course, meaning inflation, those are things we should watch very, very closely.
If we go back a few decades, it seems that monetary and fiscal policy was by and large unconstrained. Anytime you had a downturn or a hint of a downturn, stimulus came in. Do you believe we've entered a new regime with tighter structural limits?
Absolutely. I think it's important to note when we talk about fiscal situation, I think that there's a boy who cried wolf element to all of this. People have been talking about this for so long, warning about problems. It's unsustainable. I think a lot of people, a lot of investors are just almost kind of tired of it. But it's important to compare. When we go back to 2011, 2012, you had fiscal deficits as a share of the economy. They were about the same size as they are today. So no real difference. But at that time, you had unemployment that was 8%, right? You had large deficits because you had an economy that was in a deep slump after the GFC. So you had unemployment that was very high, which means that you have tax receipts that are very low on a cyclical basis. You have transfer payments, means-tested transfer payments that are very high on a cyclically adjusted basis. These deficits that we're running today, again, same size, but once you adjust for where we are in the business cycle and the fact that we've had sub 4% unemployment, now 4.2% unemployment, but still very, very low, tax receipts very high, these deficits are about twice as large, again, when you account for the state of the economy. So I think that again, it's an important distinction, and one I think that should focus minds about where we are in relation to, again, just the size of deficits. And it also, to your question, I think raises genuine questions about where we would be from a deficit perspective with no change in policy if we were to have a recession, right? It seems that if you were to have a 2 percentage point increase in the unemployment rate, again, a decline in tax receipts, increase in transfer spending, you would probably have a deficit today that's 9% of GDP without any stimulus, without any policy change, just as a natural response to the changes in fundamentals. So, that would be the starting point. Would you, add a 4% of GDP stimulus like we've done in the recent past on top of that? I think that would be a very hard sell to bond markets. And then, of course, when you think about QE, you think about the balance sheet expansion, the large scale asset purchases in the central bank. I think if they were doing that on the scale that we saw in the prior decade, in the context of deficits that large, I think that is also what would cause bond market investors to get very skittish. So I do think it is the potential rise in yields in response to discretionary policy intervention, stimulus, that does act as a constraint today in a way that it certainly did not during that long decade of below target inflation, low productivity, and really just savings in excess of investment demand.
At the beginning of our conversation, you talked about having a great interest in studying incentives. So there's clearly an incentive to keep the party going as long as you can, right? When there's a downturn or some slow indicators, you want to provide stimulus. You want to try to provide monetary stimulus, fiscal stimulus if you're a policymaker, because you want to try to support the economy. But eventually, if you overdo it, and you talked about the deficit today during good times, you run into constraints. And ultimately, that's what can change the behavior, considering the incentives plus the constraints. And we haven't had constraints for a long time, and maybe that may be changing.
It's an interesting setup, certainly. And that is why, again, we can talk about the path for short-term interest rates. And I do think that waiting, for example, for a genuine downturn to take interest rates, short-term interest rates down, is something that also is prudent insofar as if you take them down today in advance of that, not only do you risk inflation, but you're actually perhaps have less ammunition when a stimulus in the form of much lower short-term interest rates might actually be necessary. So I do think that it's probably a time to think about what are the adjustments going to occur in the event of a downturn, what sort of ammunition, again, do policymakers have, and just understand that this is likely to be a somewhat different environment, if not completely different, relative to what we experienced over the past decade. And also, I do think that it's interesting after when you look at the Republicans, for example, taking the House of Representatives, the Senate in the 2010 election. After that point, there was a sense that central banks were the only game in town. I think that was a L. Arian book title. And that was, that central banks started to take responsibility for getting us out of this slump through experimental policies. And, they pushed further and further. And what was interesting, because we're coming up the 2025 review of the Fed longer term policy objectives is coming up. But what was fascinating about the 2020 review, this happens every 5 years, was when the Fed looked back on that prior 10 years, all the QE, zero interest rate policy, what they essentially decided was that policy was too tight. And that was why they changed their inflation target, where it was still 2% as announced in 2012, but now they would tolerate a period of somewhat higher inflation. So they were going to look at an average, over time. So that if the 2% target was not hit because it was 1.5% for a while, well, then they would accept 2.5%. It was just this idea of symmetry. We failed to hit it. Inflation was too low, so therefore we'll allow it to be a bit higher. So again, it's amazing to think back just 5 years ago, because it was just a sense of this no constraints at all. That if anything, again, we were the Fed suggesting, if anything, we were too tight. And I think, again, that very likely contributed to the inflation that broke out and just the decision to wait as long as they did to taper QE to start raising interest rates, not until, of course, March of 2022, precisely because there was a sense that inflation doesn't really exist anymore. It's these structural factors like technology, globalization, demographics. It's just like, worrying about inflation is so 1990s or 1970s. It's not something we have to really concern ourselves with. Really, what we have to concern ourselves with is making sure policy is sufficiently accommodative to hit our full employment objective.
Of course, that is on the tail end of 4 decades of low and stable inflation.
And I think that there's no doubt that these factors have, these structural forces have certainly not only lowered price pressures and served this disinflationary impulse, but also just lowered real interest rates. Ultimately, the real interest rate, the short-term interest rate net of inflation or expected inflation, is a function of savings investment propensities, savings investment fundamentals. And what we saw in the period after 2008 crisis was this substantial rise in desired savings relative to investment. And there was a lot of reasons for this. I think the biggest was, of course, just the crisis itself, the need to rebuild balance sheets, the new sense of risk aversion that many management teams had after the crisis, just a sense they didn't want to invest in things that needed to be financed because sometimes that finance is not available. But a big part of it was this move in the corporate sector to asset-light business models. It was the growth of digital companies, virtual businesses. It was companies that could generate incremental sales, incremental revenue without any fixed investment, without any additional hiring. And, ultimately you had companies, mega cap companies in the United States, where it's typical to make, 75, 80 billion dollars of cash from operations and only invest 10, $12 billion back in the business in terms of capex. So it just led to this massive savings, massive cash generation. There was very large balance sheet cash holdings, securities holdings. Of course, it funded huge share repurchase programs, special dividends, but it also just generally contributed these low real interest rates. As you had an economy that shifted from an industrial age where to grow, you had to invest, build new factories, buy more equipment, invest in logistics and distribution systems, to a corporate sector that actually didn't have the same degree of capital needs. And so I think that this is interesting because this is something that's changed since the pandemic. It's not related to the pandemic. It's, of course, related to the rise of AI, LLMs, generative AI, and the enormous capital needs. And so, for example, if you look at NVIDIA's top 5 customers in the United States, they went from CapEx consuming only 35% of cash from operations prior to the pandemic to today consuming more than 70%. And that is growing so fast that we could be in a situation in the very near future where those companies actually have to rely on external finance to meet their CapEx budgets. This is extraordinary to think about. Again, the largest contributors of liquidity, of savings to the rest of the economy 5 or 6 years ago, now actually not having sufficient cash from operations to fund their own capital budgets. So I think, again, it's not just inflation, and that, although that is something that clearly driven by technology, demographics, globalization, but it's also just that this change in the corporate sector, both the move to digitalization after 2008, and then now this enthusiasm for massive AI infrastructure spending, and of course, especially the power needs that are associated with it.
A lot of the conversation around AI is focused on what its future holds. You touched a little bit on this, but what are the real economic impacts happening right now on companies, productivity, GDP growth, inflation, and also, that money that is being spent on CapEx used to go to dividends and share buybacks, but that's been diverted as well.
What really interests me about the discourse in AI is that when people ask me about it, or we enter in a discussion about AI, They want to talk about the future of work. They want to talk about productivity growth. They want to talk about the massive future disinflation that's coming from AI. Sometimes they want to talk about alignment issues and how we ensure we don't end up with Skynet and a war with the machines. But it's always about the future. It's always, what is on the horizon. And I find this so fascinating because AI investment in the United States, when you total up the infrastructure spending related to construction, the GPUs, the server stacks, and again, the power investment, especially, it accounted for half of the US GDP growth in the first half of the year, 0.6% of GDP from, again, this relatively small sector, or at least, in terms of its typical contribution to the overall economy. That's really remarkable. I don't know of any boom, any concentrated CapEx boom we've had in history where people are somehow not interested in it, or at least only interested in what it means in a year, 2 years, 5 years time. And so I think, again, it's an asymmetric response to what is driving so much of the economic growth right now. I do think that, again, there's lots of reasons to be very optimistic, but there's an interim step on the road. And that is, as we've discovered, to reach that endpoint that many of the futurists talk to us about, the agentic economy, the dramatic reconfiguration of workflows, and all the disinflation that may come, that this interim step requires trillions of dollars of fixed investment. And some people suggest trillions of dollars in annual fixed investment in the not too near future. And to me, that doesn't sound so crazy because we're already at a point today where we're spending hundreds of billions of dollars on a quarter. And the metrics that we see suggest it's still growing at a 40 to 60% annual rate. Typically when you have something that's growing so rapidly, the year ago comps get so high that the growth rate has, it almost arithmetically has to slow. And that's not happening. And so it's really, really interesting. And again, we have not seen a concentrated CapEx boom like this since, in 25 years. I think you could certainly compare it to telecom, mobile telephony, of course, the broadband, but especially fiber optics. Before that, I think it was electrification that really took off in the 1920s. Prior to that, probably the railroads. But it's, yes, I'm very excited about the future. Certainly have a lot of estimates and different ideas about some of the impacts on productivity, the downstream impacts, the investment implications. But I think first and foremost, we just have to appreciate that this is one of those concentrated CapEx boom that is really quite historic and only comparable to a few that we've seen over the past 150 years.
Where do you think the revenue to justify all that spending will come from?
I think it's a risk that I'm concerned about, certainly. But I think that the bigger issue for me right now is when I look at the stock market and I look at, people focus on the concentration in the stock market. So you have the top 10 companies in terms of market cap that account for, about 40% of the S&P 500. That is higher than it was in 2000. But I think that there's actually a bigger problem. And that's that it's not just the concentration of a small number of companies, it's that these companies are basically doing the same thing, or, you could say are essentially exposed to the same risk factors. So, it's one thing if you have a concentrated market, but it's companies like GE and Pfizer and ExxonMobil, and these are companies in different markets doing different things, pursuing different corporate strategies.
Right, diversified concentration.
Exactly, diversified. Right, almost a paradox, but that's exactly what it was, and that's not the feeling today. Right, it is concentration on, again, pursuing what looks to be similar strategies, or at least, again, exposed to very similar risk factors. And so I think that that's what gives me pause. It's not that this all won't work out, or that the revenues won't materialize, and the use cases and apps and business applications, consumer applications won't materialize. It's just that if it does not, that they're just thinking probabilistically, or assessing both sides up and down. It just feels like, wow, we really, from a stock market perspective, have a lot of eggs in a single basket.
Well, we've talked about inflation. We just covered AI. The other big topic today is tariffs. Let me ask you, what is the purpose, impact, and risk of tariffs?
We opened the year with that question, that very same, what is the purpose of tariffs? And it was really interesting to talk to people from the campaign and people that were going into the administration, because when you asked everyone knew the president was enthusiastic about tariffs. Everyone knew tariffs were coming, but it wasn't so obvious what they were supposed to accomplish. Why were they being imposed? And when you talk to people, four different people had four different answers. And so it was just, before you could really assess what tariffs would mean for the economy, you first had to know, what would success look like? Why is this being done? And I do think that we've learned that tariffs are functioning effectively as a backdoor value-added tax. And this is, I think, whether you like tariffs or don't like tariffs, I mean, obviously, as an orthodox economist, you have to, say that this is not a good idea, right? That this is sort of impedes some of the basics. When you think about specialization or trade, it's this is as fundamental as it gets to economics, right? The household that doesn't have to make its own clothes or build its own home or grow its own food, that can specialize in one occupational pursuit, is going to be wealthier than an economy where people have to provide all of their own necessities. And the same thing is true, when you generalize to an economy, that the more you can specialize, the richer you're going to be, the more you can trade, and again, have some of those activities that are better matched to productivity levels, living standards, wage levels, et cetera. So again, with that, but this idea of a backdoor value-added tax, we do have to appreciate that this is welcome news from a fiscal perspective. So a value-added tax is something that the United States is really alone among its trading partners without a border-adjusted value-added tax. There was really virtually no likelihood that one would come into law, because the VAT is something that's generally opposed by Democrats because it's regressive. It hits lower-income households harder. Generally opposed by Republicans because they associate it with socialism, or at least they see it as a revenue source in economies that have much larger public sectors. So really just no appetite for a VAT, but that's effectively what's been imposed here. And instead of a VAT that is 41% or 40% of GDP, that's generally the tax base for VATs in other advanced economies. This tax base is relatively small. It's only about 11% or 11.5%, and that's the goods imports to the United States. But I think that what we've seen over the course of the year is that these tariff rates are designed, almost perfectly calibrated, to maximize revenue. So they're high enough where they're generating a lot of revenue. I mean, tariffs in the second quarter, imports were down because there was so much front loading of components, parts, inputs, raw materials in Q1 in advance of tariffs. So imports were depressed in Q2, yet tariffs still generated 0.8% of GDP in revenue. So to think that tariffs on a going forward basis at roughly these levels could generate $3.5 trillion over a 10-year budget window is perfectly reasonable. I mean, I think that that's actually likely. And again, it's because of, instead of having cripplingly high tariffs to change relative prices, to essentially force certain economic activities back to the United States, it's at levels of that 10 to 20% range where it's painful, but it's not sufficiently high to really change anything in terms of industrial organization or the location of production. So I think it's going to have a minimal impact on the geography of production processes, but actually raise quite a lot of revenue. So that's interesting because I think, again, that's something that we've learned over the course of the year. And I think if you were to go back a few months, you might have thought that some of the tariff rates would be considerably higher. Again, because there was the objective would be different, where the objective is actually no, we want this type of manufacturing back in the United States, and therefore we're going to take tariffs up to whatever levels are necessary to make it economic to produce in the United States rather than elsewhere in the world.
I guess one of the big questions that's an open question is who pays the tax, right? Who pays that added cost? Is it consumers? Is it businesses through lower margins? Is it exporters? And that is yet to be seen.
Well, I think that what we've learned, again, for over the past few months, is that there is no mechanism that automatically causes increases in tariff rates to translate into increased consumer prices. And I think that, in some ways, the discourse, the media overcorrected, whereas people were so furious that President Trump were suggesting that other countries pay tariffs, that they started to insist that 100% of the cost is borne by the consumer. And that's not true. If you look at the economic literature, it's very, very complicated. The cost, some of the cost is borne by foreign exporters. They have to accept somewhat lower import prices, lower prices that they receive from importers in the United States. Some of it, of course, is narrower margins, and then some of it is an increase in consumer prices. But when you think about it, if you look at the corporate income tax and you think about the incidence of taxation, who pays the corporate income tax? This again, another fertile area of empirical research. The suggestion that shareholders pay about 30 to 35%, and the rest is paid by workers in the form of lower wages and also consumers in the form of higher prices. And I think this is interesting because I couldn't imagine anyone suggesting that they oppose an increase in the corporate tax rate because of its inflationary impact, right? So the incidence of taxation is extremely complicated. In this case, I think, first of all, we have seen less inflation than I would have expected, or less impact on consumer prices than I would have expected, because that front loading of deliveries in Q1 was so much larger than I would have expected. Even, we started to see this in our portfolio data in December and January. And so the demand indicators for, again, components, parts, raw materials, other inputs would have suggested that U.S. industrial production was growing at something like a 7% annualized rate. It just, looked like things were booming. Of course, that wasn't happening. It was just that there was this building of stocks, building of inventories. And our data suggested as of March 31st, inventories were almost 40% larger than they were relative to year-ago levels. So some retail, but mostly that is, again, intermediate goods, components, parts, et cetera. Well, that finished July, according to our data, at about 4% above year-ago levels. So effectively, these inventories that acted as a buffer, and again, the fact that if you have an inventory, you can continue to operate, continue to sell down without changing prices. It doesn't have any effect on your economics. So that very important buffer from the effects of tariffs has more or less run out. And I would suspect when we look at our data at the end of this month, at the end of August, that they're gone entirely. So the rubber is hitting the road now, and I think that this is where you're going to see. Now it comes down to demand elasticities. What is the price elasticity of demand in your market? What is the price elasticity of demand across the various products that you sell? And I think in those, it's going to be very specific. There's going to be places where businesses are going to find they can push on price, and they can, in some cases, actually increase prices more than the increase in their cost of goods sold. There'll be other categories where there's actually, it would be self-defeating to try to increase prices because there's going to be demand destruction instead. And that's where you'll see some of the slowdown in consumption. So again, it's going to be very interesting. I think that we've sort of been spared some of these effects because of that inventory accumulation, some of the competitive pressure, some of the just ambiguity about how long the tariffs will be in effect. But it will be something that becomes more evident in the coming months. And I would just say that when you think about it, there is a budget constraint. There is if you hold income constant and you increase the prices for some things like durable goods, if more of that income is consumed by those imported durable goods, well, that could mean actually that you spend less on travel, tourism, dining out. And so I would caution investors to not simply look at it from an accounting perspective, who has seen their cost of goods sold increase, and therefore where the margin is going to be compressed, or where the sales volume is going to come down, or where is the inflation going to manifest itself, because you could see a change in spending patterns. And that some of the discretionary categories that have nothing to do, no exposure to tariffs, could actually bear a larger share of the adjustment than many people suppose.
So, given the economic and market backdrop that you just described, let's turn to what investors can do about it. In the past, and I'll start with bonds. In the past, investors could rely on bonds to hedge equity risk, but that seems less reliable today given sticky inflation. How do you see the role of fixed income evolving, and what alternatives are emerging as effective diversifiers?
There's two issues that are related to one another. The first, when you think about the diversification that is available through the stock market, it's gone down quite considerably over the last 20 years. Part of that is just the decline in the number of public companies, from the US, from something like 8,000 to about 3,500 today. But of course, when you look at the demography of those companies, it's basically yesterday's growth stocks that have essentially migrated to private markets, or essentially have just stayed private, that then instead of pursuing an IPO, have chosen to avail themselves of private capital to grow, for liquidity for the founders, whatever the purpose is. And it's actually those stocks that provided the greatest diversification benefit in the past, because generally they're pursuing idiosyncratic strategies, right? That some succeed, some don't, but it's those offsetting deviations, the efforts to grow, that provided most of the diversification benefit. So that's gone away in the stock market. That didn't really have much of an impact on investors' portfolios over the last 10, 15, 20 years, you could say, because they got the diversification benefit from bonds. So now the stocks move more or less together. But when the stock market goes down, you could rely on bond prices rising. And a lot of that, again, had to do with low inflation, not having to worry about inflation. But more importantly, the way low inflation, or non-existent inflation, you could say, opened the door for the Fed to ease policy massively at any sign of economic troubles. The economy hit a pothole, the Fed would reliably launch another round of QE. The stock market falls by 10%, the Fed would launch another round of QE. Well, think about what that means. That means the Fed is actively making purchases of long-term bonds with the intention of driving down their yields, essentially pushing up their market values. And that's how you got into, of course, the risk parity trades, the idea that you could hedge your stock market risk on really a one-for-one basis with leverage positions in bonds, because it was just so reliable that the value of your bond portfolio would rise whenever that the stock market sold off. So I think that these are the twin problems today, that this lack of diversification, or at least not the same degree of diversification available in the stock market, and now the potential that this changed inflation regime and the way that central banks are perhaps constrained has changed the hedge value of bonds. And I would just say that one of the things that's interesting when talking to people, they very often think that the negative stock and bond return correlation is some like physical law of nature, that this is just how things work. But actually, when you look historically, the 70s, 80s, and 90s, actually stocks and bonds tended to have positive correlation in their returns. And when you think about things like stagflation risk, harming bonds and stocks at the same time, you think about changes in real discount rates. Again, real discount rates reducing stock values, higher real discount rates reducing stock present value of future cash flows, at the same time that they reduce the market value of bonds. These are things that actually were more regular than not prior to 2000. So it's really just the way that inflation came out of the system, the way that central banks could be really one-sided, focusing on their employment or their macroeconomic stability mandate, not having to worry about inflation, that generated this enormous and very valuable hedge benefit from bonds. But I think that if you look over the last 3 years, that's gone. If you look at monthly returns in treasuries and U.S. stock market, it's been about a 60% positive correlation on a 3-year moving average basis, but again, on a monthly returns. And if you look at April, especially, where you had this time where you would expect bonds to be especially valuable if they're a hedge asset, S&P 500 draws down by about 12% following Liberation Day. Well, bonds actually sold off in tandem, so you're losing on both sides of your portfolio. I think that was that kind of acute event that really drove home this changed correlative relationship.
And I think one way to look at it is you have big changes in growth over time, and you could potentially have big changes in inflation over time. And when one of those factors, and inflation in this case, didn't really move for decades, then you can just diversify by owning things that do well in different growth environments like stocks and bonds. But when inflation is uncertain once again, and we don't know where it's going to head, and there's potentially pressures for it to stay higher than target for an extended period of time, then you have to reconsider what it means to be diversified. And I suppose part of that is owning inflation hedge assets as well.
Absolutely, and I think again there is the diversification first in the equity in the equity portion of your portfolio. I don't think that that's possible outside of private markets. I think that having shorter duration, so being in floating rate loans, is something that people right now, the prospect of rate cuts, well, the loan value, the coupon interest on the loans is going to go down. Well, that's you might be looking at very significant capital losses on your fixed income, depending again on inflation expectations or the way that monetary policy is greeted by policymakers. You also, again, have the situation where sometimes when in the past in bull markets in the stock market, the Fed would raise rates in response, and bonds went up in value because they actually cheered that the Fed was ensuring that the inflation wasn't going to get out of control. So it's just, there's so many different environments, so that in those cases, bonds and stocks rising together because of tighter monetary policy being tight in response to the stock market boom, but then bond market investors worried about inflation, saying, oh, thank goodness the central bank has my back, raising rates to ensure inflation doesn't break out. These are the sorts of scenarios that people haven't really had to consider for 20 years. But now all of a sudden, this kind of scenario analysis becomes essential to make sure that you don't experience those kinds of portfolio drawdowns where both sides of your portfolio are falling simultaneously.
A lot of what we've discussed is the potential that the world ahead looks very different from the macro conditions of the last decade. And I'd say with greater uncertainty on multiple fronts. Yet when we look at many portfolios, and I look at these all the time, to me, they seem less diversified than they were. And meaning more heavily allocated to equities, more concentrated in US markets, and even more narrowly concentrated within a handful of US stocks. What general advice do you have for investors who are trying to navigate this environment?
Over the last 20 years, the big change that we've observed has been that this changed in attitudes among founders, entrepreneurs, and management teams, and that in favor of private rather than public capital. It's very dramatic. We did a survey before the pandemic, talking to our CEOs about becoming public company CEOs if a company goes public, and about 40% said that they wanted no part of being a public company CEO. And when following up, asking why that was, it was just a sense that maybe 30% of your time is spent dealing with this constantly churning shareholder base, having to be a stock salesperson. I just want to operate the business. I'm want to manage my talent. hit our objectives. I don't want to spend all of my time doing that. And so, this change in attitudes is again reflected in the reduction in the number of public companies. It's also when you look at listing propensity, which is what is the likelihood that a company that arises above certain size thresholds, whether in terms of its enterprise value or number of employees, what are the likelihood that it goes public? And depending on the threshold used, we could say 500 employees. That's gone down from about 40%, so about 2 in 5 companies pursuing an IPO in the next 18 months, to now about 1 in 7. And so the important thing is that as the investment opportunity set moves, as it moves in the direction of privates, for no reason other than that, the companies themselves, entrepreneurs, founders, management teams are preferring private capital. I don't see how it's possible to diversify or keep your portfolio static as though nothing has changed. And I think that as you suggested with the way portfolios have become less diversified, it's really hard when you see American stocks outperform for 14 years. I think it was about 700 basis points annualized. Boy, that's quite remarkable. Similarly, when you look at the mega cap companies, and you look at the net income growth, and you look at, again, these are great companies. The rents they collect from their platforms, it's tough to ignore. But I think, again, the nature of diversification is the idea of an inherently uncertain set of future outcomes. I remember, in the mid of 2000s when I was in the NEC, there was just this enormous enthusiasm for emerging markets. Markets like Brazil, certainly as China opened its stock market. And there was just this sense after the global financial crisis that, the advanced economies are dead. There's no growth there. The demographics don't look so good. You really need to have all of your money invested in emerging markets. And that seems so crazy today, to think back to that age. But it underscores that we live in an uncertain world, and the inability to forecast the future with any clarity. The only way to manage that uncertainty is through diversification and through, again, appreciation for the way the investment opportunity set changes over time.
That example that you just shared is so interesting because at the same time when that was the prevailing view, that was the beginning of the great divergence of US stocks significantly outperforming all other markets. And now here you are at the other end of that range where the outlook is so favorable for the US versus those other economies. And it just makes you wonder if that tide is about to turn.
That's the thing that when people look back, it's like, oh, well, we could have just invested in the S&P 500 and with the returns. And yes, that of course, that's true with the benefit of hindsight. Unfortunately, when you're in 2035, you're not going to have been able to seeing the 10 years unfold to make your 2025 asset allocation decisions.
Right. And the whole point of diversification is just the appreciation and realization that we don't know what the next decade holds. And the potential range of outcomes is probably pretty wide given the macroeconomic conditions that you described. So be diversified. And if you look forward, it's probably more uncertain than it's been for a long time. Yet most portfolios are more concentrated than they have been for a long time. And there seems to be a disconnect there.
That is certainly, I think, the challenge of the moment. And again, it's appreciation for the past, appreciation for the present, but always the risk of driving with the rearview mirror. That's the big risk I think you see very often. And again, just in some cases, not appreciating the scale of the changes. I think when people talk about private markets, it's so often this time is spent on the supply side. The players in the market, the funds that are being raised, those sorts of things. Not enough on the demand for capital. And that's where the changes have been more dramatic. I mean, when Amazon went public, it was 3 years after its founding. And why did it go public so soon? Because it grew to a level where they had no choice. There was no developed private market at that time. At that time, private markets were simply early stage venture and then late stage buyout, which was largely delistings, LBO, take private with an expectation of refloating the company after it's been fixed or changed strategic direction. Since then, now you have companies and Amazon probably wouldn't go public until 12 or 15 years after its founding. That's the change. So it's the diversifying growth of companies that you don't even know of today that you're not going to be able to get in the stock market. That's, I think, probably what the in terms of what is the material, what is the meaning of the change in the investment opportunities that I talked about. That's more of what I mean.
So you've talked about diversifying within private markets because you get greater exposure to great companies that may happen to be private instead of public. But how do you think about diversification in the sense of economic sensitivity of those companies?
Again, right now, I think that there is still insufficient compensation for duration risk. And what I mean is, if you go back to really pre-GFC, for on average, you would get, if you held a 10-year treasury note, your yield would be about 150 basis points to 200 basis points higher than the expected yield on money market funds or bills, treasury bills, over that safe 10-year window. So not just that moment in time, but the expected path for short rates over the same holding period. After the GFC, that premium went away. And it went away because obviously there was the expectation of the Fed action, the QE. And that's where you had, again, because bonds were a negative beta asset, because they reliably hedged equity market risk, they didn't need to have a risk premium. In fact, the risk premium could be negative, again, by nature of the negative beta aspect. And now, again, if we are living in a different world, if we are living in a world that looks closer to what prevailed in the 70s, 80s, and 90s, investing in longer term treasuries should generate some premium. You shouldn't be satisfied with 15 or 20 basis points. You should demand greater compensation for the potential volatility ahead. So I think that risk exposure is one that is underappreciated, and that's places like infrastructure, where you can get duration, but then it's actually not fixed in terms of the income, but actually adjusts through inflation or other contractual provisions. So you're getting longer duration assets in terms of the cash flow profile, but the cash flows themselves adjust up and down with the economics. So you're not taking sizable losses in the event that there is some backup in yields, because again, it's generally tied to those same factors. And then, I would say, I think that with AI, it's very much thinking about downstream exposure, that where is the value ultimately going to accrue here? Because if there's one thing we know about markets, when there is a CapEx boom or a technology shock of this sort, markets look for the choke points initially. In the 1920s, when you look at that dramatic run-up in the stock market, it was mostly explained by electric companies and electric equipment manufacturers. It was just a sense that, okay, something fundamental has changed here. This electricity is really going to be a big deal. I need to invest in the companies that, again, are laying the wires, building the boilers, making the other equipment. But in fact, it was actually the durable goods manufacturers who captured most of the benefit. So it was, we didn't have things like ovens and toasters and vacuum cleaners. Then the radio, to plug in radio, all of a sudden that led to the development of an entirely different type of content industry. So it was just the focus on where the choke point was, what was most obvious, actually didn't turn out very well. It was thinking about, what is downstream, what's next. And I think the same thing is true when you looked at the internet. Of course, the Cisco and, you see a choke point, we need more routers, we need more packet switching, we need more fiber. But ultimately, the benefits accrued to what was downstream. Famously, Walmart, because of the way that the distributed computing allowed for much more efficient inventory management, accounted for something like 1/6 of the related productivity gains. Also, of course, allowed GE, other manufacturers through the network computing to really just dramatically streamline value chains and production processes. So I think that with AI, again, it's not whether you're bullish or perhaps skeptical. It's just being more attuned to where that value is ultimately going to accrue, and being attuned to the tendency of markets to overemphasize those initial choke points related to hardware, or the finiteness of the new technology.
And potentially the answer is be diversified. Don't try to guess exactly how it's going to play out. Diversify across markets, public, private, different asset classes, across all those.
And I think the diversification also allows for a lot of learning by doing, insofar as you start to see some of the benefits of AI downstream accrue to certain businesses, and then that allows you, to invest more, and again have that exposure. But I just don't think it's possible today, with any precision at least, to know where that value is going to accrue. So you want to have your bets pretty widely distributed, I would think.
One of the areas within private markets that has had a lot of interest is private credit. And if you just look at the yield of private credit, it's relatively attractive, often offering equity like returns and higher up in the capital structure. Obviously, you give up some liquidity for that. With so many new strategies and significant capital inflows, what are your thoughts on the opportunity set today?
It's exactly as you describe in terms of why is there investor interest. It's very obvious. If you can get returns, expected returns, that are in excess of what you're expecting from the stock market, but you're sitting at the top of the capital structure rather than having the residual claim and dealing with that risk, and market risk, it's of course again a very attractive proposition for a lot of investors. I think that in the near term, one of the issues in a direct lending space, we'll say, is that in direct lending is essentially private credit where you're lending to sponsored M&A activity. So if a private equity fund is buying a company, that the portion, that the credit portion of the capital structure very often will be provided by a direct lender. So that sponsored based M&A flow has been somewhat subdued. And interestingly, the higher interest rates that have actually made the expected returns on private credit so attractive are also in some cases what has slowed the M&A activity, because you have an inventory of assets that were acquired in a very different interest rate regime. So, basically anything acquired before the second half of 2022 was, of course, acquired when base rates were close to zero. And more importantly, especially in 2021, the expectations that base rates are going to be zero through 2024, for a long, long time in the future. So that again, the adjustment has led to, some a bid-ask spread. It's similar to what we've seen in housing markets, where you have existing owner with a relatively low financing, prospective buyer has to pay more for their mortgage. There's, not as many transactions as there were previously. So I think that the only risk I would say in the direct lending space is just can the inflows and the interest in these instruments and the prospective returns, is it matched by the number of deals? And right now you could say that maybe it looks like there's a market where there's a bit more lenders than there are borrowers. I think that that's probably going to correct itself, starting in 2026 would be my guess, and you'll see a pickup in M&A activity. But in the short run, that's the only risk I would say. I think that the much more attractive areas in private credit is the non-sponsored lending. So those are where you're originating loans. Maybe it's family businesses. Maybe it's another business in some sort of special situation where it expects a liquidity event like a listing or something in the next 18 months, but needs cash today. And then also asset-backed finance, or you could say investment-grade private credit. This is an area where sometimes you have irregular collateral, like a loan collateral, that it doesn't really lend itself to the public securitization markets. Maybe there's some drawdown feature where the borrower has the ability to take the loan down, increase the loan balance over time. Just some feature that makes it so it's not so easily securitized in public markets. Those areas are both very, very attractive, where the spreads in private markets are still very robust relative to anything you see with equivalent default risk in public markets.
One of the concerns often raised about private investments is the liquidity. And as we all know, investors often prize liquidity. But do you think there's an opportunity cost to being too liquid?
I think that that's something that large institutions have discovered very clearly over the last, again, 15, 20 years. And I think there's two issues here. One is just realizing that they're giving up returns for liquidity they don't need. So there's been a lot of efforts to really focus on how much liquidity do we really need, and then okay, we'll have some buffer. We don't have to go exactly to that threshold, but let's try to optimize and try to get a better sense of the liquidity we need. So we're not leaving any returns on the table, because even if you're talking about 300 basis points, when that compounds over 10 years, you're talking about very, very different end balances. So I think that that's something that institutions have been very focused on, just not paying for liquidity that they don't need. And then secondly, what you've seen is just a realization that liquidity can be ephemeral. And so you think something's liquid, then a shock or a crisis hits and you find out it's not liquid at all. And those are the periods where I think a lot of institutions have become very frustrated, because they end up having to sell what can be sold rather than what they would like to sell. And just an example of that, in April after Liberation Day, if you look at the Russell 2000 and you divide the stocks into four quartiles based on their liquidity, either based on prior turnover or bid-ask spread, you find that the highest quartile of stocks in terms of liquidity sold off by 400 basis points more than the least liquid quartile. And that's interesting because, again, it's just a sign that it wasn't people selling what they wanted to sell. It had nothing to do with companies' exposure to tariffs or companies' exposure to international markets. They were just being sold because these other stocks were too illiquid to sell. And trying to sell it just meant that you would have to take a much larger price hit, so they weren't sold. You find that also in some of the public loan markets as well, that people sell what's large, what's liquid, and then the smaller or less liquid names actually have no trading volume, because everyone realizes that if they tried to sell it, it would be a bloodbath. There's no one on the other side ready to provide liquidity. So again, I think it's paying for liquidity you don't need in terms of foregone returns. And then secondly, the realization that actually many of these assets aren't as liquid as I thought, at least in periods of stress or when there's a shock to the system.
Well, Jason, this has been fantastic. I appreciate you sharing all your insights. You have a great talent for explaining complex concepts in simple terms. So I appreciate that, and I hope our listeners did as well.
Well, thank you so much for having me. I really enjoyed it.
Thanks for listening. We hope you enjoyed this episode. Please visit our website at insightfulinvestor.org to access past shows and learn more about our podcast. If you have questions, feel free to email us at info@insightfulinvestor.org. And if you enjoyed the discussion, please subscribe to this podcast to ensure you don't miss future episodes. And don't forget to forward today's conversation to others you think would enjoy listening. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of Evoke advisors, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations, nor reference past or potential profits. And listeners are reminded that securities trading, commodity trading, and alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors. Listeners should be aware that guests featured on The Insightful Investor may have current or past associations with Evoke advisors or the host, including as an investment manager of a private fund opportunity by Evoke, or access through an affiliated Evoke fund, or as a client. Participation as a guest on the podcast should not be perceived as an endorsement or testimonial with respect to Evoke advisors, the podcast host, or their services. Similarly, the inclusion of a guest on the podcast does not imply that Evoke advisors or the host endorses the guest or any company with which they may be affiliated or employed. Evoke has neither paid nor received compensation from guests for their participation.